I think, as always, the extent to which monetary policy will help, address inflation is going to be dependent on a whole range of factors. I think if you have largely negative real interest rates, I'm not sure that that is conducive to the kind of signaling effect that you want to have, either in terms of supporting the exchange rate or the credit channel. When you have multiple exchange rates, that also becomes a lot more complicated, right? I mean, which exchange rate do you use as a benchmark? So, all of those things have to be factored in. Again, we are not absolutely dogmatic that it always has to be about interest rates increases. So that will work through the credit channel, as you said, for a large part, some by mobilizing a bit more savings. But, there are cases also where we support, managing liquidity. Even other cases where the financial markets are even more rudimentary, so outright monetary targeting, explicit money targeting is what will work. So I think it depends on a combination of those factors. And, I think you have very nuanced policymakers in Nigeria, I think, that understand that. We think that way. Yeah? So on inflation, on the inflation challenge, again, this tends to be, of course, unless you're part of a monetary union, there's a lot of variation in inflation and also a country-specific assessment that has to be done on the causes of inflation. So yes, to a significant degree, we've seen imported, the pressure on inflation has been imported. So if you're an oil importing countries, you're facing higher international oil prices, right? And depending on the extent to which it's being passed on, that's a source of inflation. Similarly, food prices having been elevated after Russia's invasion of Ukraine, that also is a channel through which inflation has risen. But